Good afternoon, everyone. On behalf of the entire team at Seaside Wealth Management, we welcome you to our annual year-end review event. My name is Tina Vierig, and I'm one of the certified financial planners on the team here at Seaside. I'm joined today by another wonderful advisor and certified financial planner, Matt Callahan, and our president and fearless leader, Brad Lineberger. Sadly, this year we're virtual. For our newer clients out there, we usually host this event in person in both San Clemente and San Diego with food and drink, which we love. So hopefully we can get back to that again next year. But before we begin, we have a couple of housekeeping items. First of all, we send out a bi-monthly newsletter to all of our clients with timely information on both financial planning and investment management topics. So if you're not receiving these emails and you would like to in the future, please let us know so we can add you to our list. Thank you all for all the positive feedback regarding the newsletter and blog. So as usual with these events, we'll go through a slide presentation with our prepared remarks to provide perspective on the markets and economy, both US and abroad. And clearly there was lots of activity in Q4, so we continue to deal with the pandemic and uncertainty around that, in addition to a new administration and post-election. So there are definitely some things to talk about there. So at the end of the presentation, we'll have time for questions and answers. So if you'd like to submit a question, you can do so at any time during the presentation by using the question and answer feature at the bottom of our screen, or you can send an email to stephanie@seasidewealth.com. And if we don't get to all the questions today on the webinar, we will follow up with you directly afterwards. So no question will go left unanswered. And in addition to that, we always welcome open dialogue regarding your investments and financial plan at any time throughout the year. So please reach out to us to schedule time. So all participants today will be in listen-only mode for the duration of the event. And lastly, we will be recording today's webinar. So in a few days, we'll be sending an email with a link to the recording in case you want to rewatch it or send it to a family member or friend. So without further delay, Brad, go ahead and kick us off.
All right. Thank you, Tina. So, what a year. I mean, 2020, who could have imagined what was going to transpire? Nobody could have predicted it. And, while it's been a challenging year for many people and we're still gripped in the throes of a pandemic, what we can do going forward is to take the lessons that we learned from last year and apply those powerful lessons to talk about how we can continue to experience financial success going forward. We're going to conclude the presentation by taking a look at where we stand today and where we anticipate things going in the future. And as Tina mentioned, we're going to have time at the end for some questions and answers. So it's been so long that you probably all forgot the fact that we came roaring into 2020 actually in a really good place. So we had, it was on the backs of a strong 2019. The stock market was booming. There was momentum. We had a tailwind. The real estate market was booming. The economy was strong. Things were looking great. But by March of 2020, the world had changed. What happened? So if you would have told me that a virus was going to come out of China, take the world by storm, claim the lives of millions of people worldwide, shut down economies, put hundreds of thousands of people out of work, and lead to massive stay-at-home orders, I would have told you this is some science fiction story that my fourth grade son, Jake, came up with at school one day. I mean, who would have thought that? But that's exactly what happened. And so on January 8th, there was a new virus discovered by Chinese scientists. And so that was kind of the first word that we got about it. Our markets at home hadn't yet to go into panic mode. It was February 12th and the Dow closes at a record high. And then on March 9th, oil prices collapsed as Saudi Arabia decides they're going to really flood the market with supply, and the bottom fell out of the oil market. And it was on March 11th that coronavirus was declared a pandemic by the World Health Organization. And that was about the time that the NCAA tournament, March Madness, was canceled. The NBA season was canceled. Spring training was canceled. My kids' sports was canceled. School, my Vanessa found herself homeschooling 4 kids all of a sudden overnight, and the world ground to a halt. So how did the markets react? Well, it took 6 days to hit correction territory, which is defined as a 10% decline in the markets. And on March 12th, the stock market hit bear market territory, which made this the fastest descent into bear market territory in history. And on March 23rd, the stock market hit the bottom, down 34% from its all-time high on February 19th. Literally, this was, depending on which index you follow, it was between 16 and 22 trading days to hit the bottom. But by any measure, this was the fastest descent into bear market territory that we have ever experienced. So there we were, late March, and we're in the throes of a bear market. This was the 13th bear market since World War II. Now, on average, bear markets go down about 30%. So this was normal. This was average. But typically, it takes about a year for that bear market to be fully in place. And then once we get there, it takes usually about 2 years to recover. So from the peak to the trough back to the peak, it's about a 3-year experience. And that's what was very different about 2020, was that everything was fast. So at this point in time, amidst all the uncertainty, people were asking great questions. What should we do? Should we go to cash? Should we change our asset allocation? Should we make adjustments to the portfolio? What should we do? Now, you've seen this before, but it's worth mentioning again that if you miss just the best single day, and we're talking in a 30-year period, your long-term returns can be greatly diminished. So in a 30-year period, if you miss the best one day, your long-term returns are reduced by about 0.5% per year. If you miss just 25 days in a 30-year period, your long-term returns are cut in half. And for many of you, that means your long-term financial plan could be fully derailed at this point. And the scary part is, oftentimes, the best one-day returns come right on the heels of the worst one-day returns. So we always tell people it's important to not to try and market time and not to try to go to cash. Now, it's easy for me to sit here and tell you that. And right now, it's probably easy to digest that. We all know that that's the right course of action. But when you look at the amount of volatility last year, and what you're looking at here, this is 2020, we experienced over 40 trading days that had more than 2% swings in a day. In other words, the market was up or down more than 2%, more than 40 days last year. So that was on par with the financial crisis of 2008 and 09. It was also on par with the dot-com bubble bursting, the tech wreck of 2000 to 2002. So if you, at any point throughout the year last year, found yourself feeling uncomfortable, uncertain, a little bit nervous, you had every right to feel that way, because as we can see, this was a very, very volatile year. And I love this one. So statistics show that the best penalty kick strategy for goalkeepers is to stay in the middle. They should just stay in the middle of the net, and they'd have much higher odds of actually blocking a penalty kick. But they jump left or right 94% of the time. And I think this relates very well to investing, because the best strategy is not to jump left or right. In other words, don't sell. Don't react, don't panic, don't sell out, and also don't chase the shiny object. You need to remain in the middle, which means stay the course, remain invested, fully diversified, rebalance through markets, but don't be jumping in and out of them. It's very dangerous. So if you could have maintained that discipline, you would have been very rewarded in 2020. So 2020 was no exception. So on March 24th, the market is up 11% in one day. This is the best single day return that we've seen since 1933. So another one of those statistics. And had you gone to cash, you would have missed this, and your long-term returns would have been permanently lower. And here's the ironic thing, and that is, if you were to ask Matt or Tina or myself on March 23rd, hey, do you guys think this is the bottom? Are you willing to go all in with any cash that you may have? Are you willing to just put it all in? We would have said, probably not. Who knows? Is this the bottom? We don't know for sure. Certainly didn't feel like it at the time, but it turned out it to be the very bottom. And you know what they say, sometimes it's darkest right before the dawn. So 2020 was no exception. We saw a phenomenal one-day bounce on the 24th. And then the market went on to post the best 50 days in the US stock market ever in the history of the stock market. And so by June 8th, the S&P 500 was back in positive territory, leading people to ask the following three questions. And they're great questions. We touched on them a little bit in October, so I'll move through them briefly, but it's worth noting, it's worth revisiting these things because they're really good questions. Number one, why was the market in positive territory when the economy as a whole felt like it was in the tank? Number two, should we be buying individual stocks of companies like Amazon and Apple and the big tech companies that were doing really well? And number three, should we just put all of our money in the S&P 500? So three really good questions that we were getting asked, and we wanted to unpack them one at a time. So the first one, why was the market in positive territory when the economy was in the tank? And that's a little bit misleading because when you really unpack it, you see that the broad market as a whole was not really that healthy. The positive performance, so this was somewhere about August, September, S&P 500 is up 10% at that point in time. And the performance of the S&P was really driven by five stocks: Facebook, Apple, Amazon, Netflix, Google. Combined, those five were up 49%. If you looked at the other 495 companies in the index, they were actually down 3%. So kind of misleading to think that the stock market wasn't necessarily disconnected from the economy, because 495 companies were kind of hurting, but five companies were really thriving because of the COVID conditions, the work at home. Everybody's now transitioning to tech. So any company, the large tech companies did really, really well. And so, that led to people asking, well, should we buy individual stocks of Apple and Amazon and some of those big tech companies? And our answer was and still remains no, because it's pretty risky to try and pick individual stocks. And what you're looking at here on the left is the last 5 years. If you decided you wanted to invest in individual stocks, you have pretty much a 50% probability of losing money. So the odds are fairly stacked. You have 50% odds of losing money by buying individual stocks. Whereas you're looking there on the right, if you invested in a diversified basket of securities, whether that's a mutual fund or an ETF or an index fund, you have a 93% probability of making money. So the odds are stacked in your favor by remaining highly diversified. So it's kind of, I like this. Investing in single stocks is a little bit like playing the lottery in the sense that, Americans spend $73 billion on lottery tickets every year. So that's $223 per person. The odds of winning the Powerball lottery are 1 in 292 million. So it's kind of like investing in single stocks. And when you look at last year, 5 companies are thriving out of 500. That's 1%. You had a 1% chance of hitting it. And if you hit it, you would have hit it big. You hit a grand slam for sure. Those 5 did really, really well, but you had a 99% chance of actually being down midway through the year. And so, around here, we're not about grand slams and strikeouts. We're about singles, doubles, and triples, staying consistent to help you move forward towards accomplishing your goals. So we want to try to minimize the risk as much as we can. So that, of course, led to the great question, third question. Well, okay, we get it. Don't buy individual stocks, or if you do, only invest enough money that you're not afraid of losing it all. So 5%, just make it kind of a fun thing. If that's your hobby, fine, we understand, but make it a small amount. But should we just invest the whole thing in the S&P? And we got asked that question a lot too. And I love this. This is the dog chasing after the S&P. It's just about to go over a cliff here. And on the dog, it says FOMO, the fear of missing out, because that's the emotion that's really driving the question. The S&P 500 has been red hot for the last 3 to 5 years. And of course, it's that fear of missing out that makes us want to chase after it. And so the answer to this question still remains no, don't do it. It's a great index, but we never want to put all of our money in any one index. And what you're looking at here, these are all of the asset classes that are represented in your portfolio. And this is the 10-year period that started in 2000 and it ended in 2009. And on the left there, it's the only red on the screen. It's the S&P 500 losing 1% per year for an entire decade. And meanwhile, the other asset classes in your portfolio some did really, really well. Emerging markets quadrupled. International companies did really well. Small companies did really well. And so a well-diversified portfolio is a mix of all these different asset classes. And we would never want to own any one in 100% concentration. So that remains today. We don't want to put everything in the S&P 500. We want to own it because it's a fabulous index, but we want to remain diversified. But you've heard me say this long enough, the importance of remaining diversified. It's not easy. It's simple, but not easy. And so I've asked Matt Callahan to come on and just share a little bit about his experience about even though it's the right thing to do, it's still really hard. And so I want to turn it over to Matt. He can share with you just kind of his experience on it.
Yeah, thanks, Brad. Hi, everyone. And so just like Brad said, it is simple, or it sounds simple to just stay disciplined throughout all market environments. But in reality, it's really hard, even for all the good investors, everyone on this phone call, to weather through all the different market environments. And so even because we see the volatility in the short term, it's hard to see that long time horizon of how things end up in the end. So what do I mean by that? Well, let's take a look at what we're looking at here. And what I'm comparing is the S&P 500 on the left versus a diversified portfolio on the right. And what I used was a 60% equity or stocks and 40% bond portfolio. And I just wanted to show you throughout all different market environments how the good investors like all of you are feeling during each of these times. So if we look at 2000 to 2002, the S&P was down 40.1% versus a diversified portfolio, which was down 17.3%. So we hear this all the time. Well, hey, I lost money, and we know it doesn't feel good to be down, 17%. But we have to keep in mind that your portfolio outperformed the market by 22.8%. And so if we look at 2003 to 2007, the S&P was up 82.9% versus your diversified portfolio up 80%. And 80% is great, but the way that you're feeling during this time is that I didn't make as much money. And then so if we move forward to 2008, the market was down 37% versus your portfolio, which would have been down 24.5%. And again, you felt like you lost money, and your portfolio did see a decrease in value. But again, we outperformed the market during that time frame by 12.5%. And you'll see later why that down protection does matter over the long term. So if we look at the decade of 2009 to 2019, the S&P went on a huge tear, and it was up 351%. And just like Brad mentioned earlier, hey, let's not chase that shiny object and jump off the cliff, because your portfolio was only up 195.3. Because now you're still feeling like I didn't make as much money as the S&P. And so last year, 2020, what we're looking at here is the first part. So January 1 until March 23rd, the bottom of the market, we were down 30.4 in the S&P 500, and a diversified portfolio was down 20.7%. And so what happened the second part? So from March 24th until the end of September, the S&P came roaring back. And again, like Brad mentioned earlier, one of the fastest recoveries from a bear market that we've seen. And so the S&P was up during that time frame 70.2%, and your portfolio would have been up 42.6%. So it may feel like during that time frame that you didn't make as much and that you didn't participate in all of that upside. But if we look from 2000 until 2020, the S&P was up 268.7%, and that diversified portfolio over that same time frame was up 275%. So diversification does work. It just doesn't feel good along the way. And so you all might be thinking, hey, Brad, Matt, Tina, we're already approaching retirement, or we're already in retirement. So we don't have 20 years of a time horizon to be able to handle this volatility. But again, we need to keep in mind that what we're planning for is that you're going to have a 20, even a 30 plus year retirement. And so we do have the time horizon to take advantage of that volatility. And I've been on a huge kick, and I'll be writing a blog on it coming soon in March about volatility is your friend, and you guys will see why. And I hope that this gives you a little color on that subject.
Perfect. Thank you, Matt. And it's so true. It's simple but not easy, and it can feel painful at times. So with that, I'm going to show, there we go. So this is back by popular demand. We call this the Skittles chart for obvious reasons. It looks like a bunch of Skittles, and we are tracking all of the asset classes in your portfolio going back over the last 15 years. And I want to point out a couple things that at the beginning of this 15-year period, you had things like the emerging markets, red hot, international companies, red hot, international small companies, red hot, US value companies, red hot. And that trend really continued in 2007, continued in 2009. And so the beginning part of this period, you saw these international investments red hot. And so I had people asking me in 2009, after the S&P 500 lost 1% per year for a decade, they said, hey, should we just get rid of the S&P 500 and let's just put everything in the emerging markets and international companies and international small companies? And we said, no, you cannot do that. And not because we can predict the future, although looking back, maybe it sounds like we could have. Nobody can. We can't predict the future. Our crystal ball broke years ago. It's just how this thing works. Each of these asset classes goes in cycles, and nobody can predict when they're going to turn on and turn off. But had you followed that temptation back in 2009 to ditch the S&P 500, you would have lost what turned into one of the hottest performing asset classes of the time. So let's fast forward. The far right column over here shows you 15-year performance. And there you go. US large companies, after being in almost dead last in 2009, are now at the top of the chart. And so what does this tell us? Should we load up on the S&P 500 at the top? No, the time to buy is really at the bottom. We should have been loading up in 2009, and that's what we were doing. That's what the disciplined process of rebalancing helps you to do. You sell at the top and you buy at the bottom, okay? The other interesting thing I want to point out is you hear us talk about areas of the market that have a higher expected return or premiums to be had if you have enough time. Things like small companies, value companies, things like that. And I want to show you that over the last 15 years, those premiums are still very much in place. US small companies are the second best performer in this 15-year period. US large value companies are the third best performer, and international small companies are the fourth best performer. So areas that do have a higher expected return, and we would expect to see at the top, continue to be at the top. But why I point this out is because over the last 3 to 5 years, we've seen some headwinds for small companies and value companies. They've not outperformed the broad US market. And there's this phenomenon called recency bias. And recency bias is taking the events of the recent past and extrapolating that years into the future. So an example would be back in 06, 07, 09, taking the hot performance of emerging markets and saying, oh, I think emerging markets is the new winner. This is the new normal. Let's load up on emerging markets. And we all know, looking back on it, that wouldn't have been the right thing to do. And another example of recency bias that could be affecting us today would be, let's load up on the S&P and let's not invest in areas that over long periods of time we would expect to outperform, but that have not outperformed in the short run, like small companies and value companies, et cetera. So don't get caught up in those emotions. Don't start to anchor around recency bias. Do maintain discipline and diversification and look and see how that can reward you. I want you to take a look at the white box here. And the white box, I'm kind of drawing a terrible line here on my white box, but you get the idea that it's always kind of in the middle. On a year-to-year basis, that white box is always in the middle. And after 15 years, that white box, which represents a diversified mix of roughly 2/3 stocks and 1/3 bonds. So a typical retiree who's going to own, somewhere between 60 and 65% stocks and 35 to 40% bonds, doing well. And notice that you're never once going to be the winner when you maintain global diversification. You'll never be at the top, But of course, you're also never at the bottom. You notice that that diversified mix is also never at the bottom. And if you give it a long enough time period, you actually end up doing quite well. And as Matt said, it can be simple, but not easy. So just wanted to point that out. All right. Okay. Now, of course, I would be remiss if I did not talk about politics. And we did touch upon this a little bit at our October event, but I want to just, with the benefit of hindsight here, we can kind of talk about how things played out. So, as if the COVID scare wasn't enough to deal with, we had one of the most bitterly contended political election cycles, presidential election cycles in recent memory. And both parties would have you believe that if the opposite candidate won, that the country was basically going to be ruined. And of course, the temptation to go to cash might have been strong for some folks. And this is a great reminder. And you've seen this in October, so I'll be brief, but I want to just remind you what this is showing you is if you only remain invested when the candidate of your political party is in office, this is showing you that that's not an effective strategy. So since 1961, $10,000 invested only when a Republican was in the White House, but not when a Democrat was in the White House, would have generated a little less than $90,000 of capital. And if you invested only when a Democrat was in office, but not when a Republican was in office, that would have turned into $376,000. But had you remained invested through both political parties, your $10,000 turned into $3,248,612. And it's just a great reminder. You need to stay fully invested, and you don't want to mix your politics and your investing. And the same is true for Congress. This is showing you that our markets are bigger than one party or one person. Okay. And so you would think that in November and December and closing out the year, the political election was still undecided. It was still bitterly contended. The country was divided. It was really a rough time. So how did the market do? And you'd think it would not be doing well in that environment. And yet we had in the U.S. stock market the third best November in the history of stocks ever in November. And when it comes to small caps in the small cap space, November was the best month of November ever in the history of small cap investing. And it just goes to show you just can't mix your politics and your investing, because markets are forward looking. They're pricing in the future. The markets are a really effective, efficient way for buyers and sellers to come together and express their ideas about the future. And to try and time it or to try and prognosticate it is really just a fool's errand. And of course, wrapping up the fourth quarter, you can see that the U.S. stock market ended up the fourth quarter up nearly 15%. The international stocks were up almost 16%. Emerging markets up nearly 20%. Real estate was making a comeback up 12.5%. So in a hotly contested period of time, in a bitterly divided period of time, our markets actually did quite well. So I think at this point, it's interesting to look at the past, and I think what's important is now let's take stock of where we're at today, and then how we can apply some of those lessons from the past to be effective and successful moving forward. So we're going to talk about things like interest rates, inflation, currency, international investments, and the performance of the premiums. So one of the most popular questions we receive is what to do with cash, with yields being so low. What should people do with cash? And remember, the 3-month Treasury bill fell significantly during the first quarter of last year as the Fed lowered the federal funds rate to nearly zero. It's part of their accommodative policies to support the economy at the time. And so we track interest rates from a variety of banks, both brick and mortar and online banks. And you can see right now rates are very, very low. And some people have asked us to do, so with their emergency fund, should they be investing in stocks because interest rates are so low? And we tell people, unless your time horizon is more than 5 years, you should not invest in stocks. And the reason why is in the short run, being 5 years or less, stock markets can be so volatile that you may actually, there have been 5-year periods where you could have lost money in a 5-year period. The odds of that are very low, but it has happened before. So unless your time period's at least 5 years, we would say, sadly, you need to remain in cash. You want the protection, the security, the liquidity of the cash. And the penalty, of course, is that rates are very, very low, unfortunately. Speaking of rates and kind of yields, you can see that bond interest rates are also very low. In fact, the 10-year Treasury closed out the year at 0.9%. It was less than 1%. So not only savers, but bond investors are getting penalized as well. And what's interesting is with interest rates this low, many financial institutions are calling for lower than normal returns on stocks in the future as well, because the premium or the return above treasuries is still going to be the same, but with interest rates so low, it may not bode well for stock returns. And that remains to be seen. No one can accurately predict it for sure. But one thing's for sure, rates on bonds and yields on bonds are very low. We still view bonds as an important part of the portfolio, as the ballast to your portfolio. So this is the part of the portfolio that actually goes up when stocks go down. We still think that there's a case to be made to have bonds in your portfolio, but just be aware that the yields and the return on bonds today are much lower than where they've been over the last 20, 30 years. As far as inflation goes, this is a really interesting topic. And when you look at it, you're getting very diverging viewpoints on inflation. You've got institutions like Morgan Stanley calling for higher than expected inflation, and Goldman Sachs calling for lower than expected inflation. So no one knows for sure, but when you look at all of the spending and the stimulus that has happened as in response to the COVID crisis, typically that would put inflationary pressures on the economy. So the good thing to note is that the asset class that holds up very, very well in an inflationary environment is stocks. And every one of us owns stocks in our portfolio, and stocks tend to be a really good inflation fighter. So that's encouraging and good to know. The other thing when it comes to inflation is we are taking a long, hard look internally at the use of what's called TIPS in the bond portfolio. And TIPS are Treasury inflation protected securities. And these things are pegged to inflation. So if inflation starts to increase, then the TIPS actually go up in value. The downside to TIPS is that if the stock market is running and doing really well and experiencing strong returns, TIPS don't fare well in that environment. So this is something that we are looking at very, very closely internally, and we'll be letting you know if it makes sense to introduce TIPS in the future. Markets are certainly pricing in higher inflation. Current readings are still remaining flat. So it's hard to know for sure in the near term where it goes. I would think that in the long term, we're potentially going to see more inflation. But one thing's for sure, I thought this was kind of funny. Get your popcorn ready. When we look at the price of many things that all of us out there like to buy, last year, the price of microwave popcorn soared by 30%. It's probably a reflection that many of us were sitting around popping popcorn and watching movies or TV at night. I know that's what my family and I certainly did. That's a hot Friday night in the Lineberger household. But popcorn was up 30% last year. Paper towels up nearly 30%. Bath tissue up 25%. I thought this was kind of interesting. And we do hear that from all of you, that the cost of things that you are buying is going up. And so again, stocks are the best way to fight inflation, and we're going to make sure that we maintain exposure to that asset class. What about the strength of the US dollar? So what you're looking at here, this is the last 20 years. The top chart here is showing the last 20 years where the dollar declined in value all the way into 08, 09, and 10. And then it's been strengthening from 2010 onwards. It peaked in early 2020, and now it started to decline a bit from starting in Q2 of last year. What does that mean? Well, a rising dollar is generally good for US consumers, as it makes foreign goods cheaper to purchase, but it's bad for the owners of non-dollar denominated investments. In other words, international investments. And so a weakening dollar, and that's been happening the last 9 or 10 months. It's bad for you, for those of you that love to travel, because it's more expensive now to exchange your currency, but it's actually good for those of us that own international investments, and that's all of us, because what happens is when the dollar is strong, if we're bringing foreign profits back into a strong dollar, we're bringing less foreign profits back. And that phenomenon is really is more than partially to blame for the less than stellar performance of the international investments over the last decade. This chart says it all. From really 2010, 11 through 2020, that decade, the dollar got really strong, and we're bringing international profits back into the strengthening dollar. It effectively was watering down your international performance. Well, now with the dollar weakening, we've already seen it happen in the fourth quarter of last year. The international investments outperformed the U.S. investments in the fourth quarter of last year, due in no small part to the weakening currency. So put another way, owning international investments is fantastic also as a currency hedge against a falling dollar. So, we've been saying for a long time that at some point the international investments are going to come roaring back and the U.S. is going to slow down a bit. We don't know for sure if that transition is underway right now, but it wouldn't be a surprise if we look back in years down the road and we see that this potentially was the beginning. Again, can't predict the future, but that's what we see happening. Remember when I mentioned that midway through the year last year, the 5 FANG stocks, Facebook, Apple, Amazon, Netflix, Google, up 49%, driving the performance of the S&P index to be up 10, while the other 495 companies in that index were actually down. We began to see a rotation in the fourth quarter of last year, a broadening out, if you will, of the performance, which is actually a really, really healthy sign. So the outperformance that we experienced the first half of the year from the FANG stocks was then replaced with the rotation into all other sectors of the S&P 500, outperforming the FANG stocks in the fourth quarter of last year. So all those beaten down, beleaguered sectors of the S&P started to perform again. And that's a really healthy thing. It means that the recovery is getting legs, that the recovery is broadening out when it's now impacting all sectors. This is really good. It's a good sign. It's a good omen of things to come. So we definitely saw that trend take place pretty sharply in the fourth quarter, and wanted to share that with you. Now, what about the performance of the premiums? And you've heard us talk about for years that there are areas of the market or dimensions of the market that have higher expected performance over time. Things like small companies and value companies. And if you give it enough time, small and value tends to outperform over time. How's that going? And you've heard us talk about the last 5, even 10 years, growth companies have been the real winner. In fact, growth, and it has nothing to do with value and small, and has everything to do with growth companies are actually outperforming their long-term average. And so what we saw, of course, in November was that small caps had the best month of November ever. So they really started to turn on and start to shine. And in the fourth quarter, value companies outperformed growth companies. And it was the first time in a while that we'd seen that happen, and it's worth noting. And we've been saying for a long time that tide's going to turn at some point. Is this the beginning of the turn? Could be. No one knows for sure, but it's noteworthy, and it was worth pointing out to you that that's definitely what we saw. And so, speaking of portfolio and investing, and we want to talk to you about some of the enhancements that we're making to your portfolio to really just continue to deliver the best possible experience we can. And a couple weeks ago, we sent out an email and I shot a video letting you know that we have hired a third-party consulting firm to come in. And really, we spent the last 6 months of last year with them doing a real deep dive on the investment portfolios. And I wanted to take a minute and just clear up. I received quite a few questions around this announcement. I just want to clear a few things up. Number one, we're not formally partnering with them. I don't work for them. They don't work for us. It's not an employee-employer relationship. They're simply an independent third-party consultant firm made up of 2 chartered financial analysts who are really, really smart, Mario Nardonis and Eric Stein. They've got years of experience at institutions like Goldman Sachs and Vanguard, and just really, really respected people from respected firms. And they help companies like ours to do deep dive analytics on all things related to the investment portfolio. And so the other question was, oh, is there going to be an extra cost passed on to you guys because we've hired this? No. So we view this that your success, we want you to succeed because your success is our success. So we are heavily invested in your success, and there is no extra cost for this. But the better you do, the better we do. And so we are in this together, and so that's why we brought East Bay in. And really, what kind of started this whole journey was a little more than a year ago, when all the major custodians, Schwab, TD Ameritrade, Fidelity, they all made the announcement that they were cutting the cost to trade ETFs to zero. So what's an ETF? It stands for Exchange Traded Fund. And an ETF is just like a mutual fund. So it looks, walks, and talks like a mutual fund, but there's a couple of subtle differences. An ETF can trade throughout the day. So if Tina puts an order in at 9 o'clock, she gets that price. If I put an order in at 10 o'clock, I get that price. Matt puts an order in at 11, he gets that price. It trades throughout the day like a stock, where a mutual fund trades, it prices once per day at 1 o'clock Pacific when the market closes. So that difference was not enough to make us like or not like an ETF. It wasn't until the custodian said, hey, there's no cost to trade an ETF. And so we paused and we took notice. And then the announcement came out that Schwab is going to be purchasing or has acquired TD Ameritrade. And somewhere in 2022, we're all going to end up back at Schwab. And fortunately, there's not going to be any paperwork that anyone has to sign. It's just going to happen. But we're staying ahead of the curve here. And we've done the homework to look at our investment portfolios and the securities held there. So TD Ameritrade is charging all of us $9.95 to make trades on the mutual funds that we have in the portfolio today. Schwab is going to be charging $25 to make a trade. And if we're doing 4 to 8 trades in a year to rebalance the portfolio and keep it in line, well, that's $100 to $200 per account. And that starts to add up over time. And so as we started down this path to do the research into, well, does it make sense to replace a mutual fund with an ETF? We realized that the more we learned, the more we needed to learn. And that's why we brought in East Bay, and boy, they were really helpful in taking that deep dive. And so the bottom line is we found that we've identified all the places in the investment portfolio where appropriate to be able to replace a mutual fund with an ETF. And so in those cases, there's not going to be a cost moving forward to trade. There will be a cost to get out of the mutual fund, but then moving forward, there will be no more trading costs of that ETF. And the other thing we found is that the ETFs are slightly less expensive. And I'm talking 10 basis points, but on $1 million, that's $1,000. So for every $1 million, you're going to save $1,000 per year, every year for the rest of your life. And for many of you out there, that's a significant amount of savings. So we thought that those two factors in combination, this became very attractive to us. So one thing you're going to notice is that we're going to start to rebalance the portfolio, and your asset allocation is going to remain the same. We are not market timing. We're not making sector bets or anything like that. We're just simply, Tina likes to use the phrase, the bus stays the same, but the passengers on the bus are going to change. We're still going in the same direction. We're keeping the same asset allocation, the same investment philosophy. We're going to deliver it in a more effective, efficient way that's really more low cost to you. So we're all going to win. You're going to win. We're going to win. This is a good thing. So we're really excited about it. And if you have any questions, or if you can tell, we're obviously passionate about what we do and kind of geek out on this stuff. So I want to save that, I don't want to go too into depth and detail here, but if you're interested and curious and want to learn more, let any of us know, and we'd be happy to share with you more of the analytics or kind of the details behind that. But yeah, that's something you're going to notice in the next quarter here, the first quarter of the year. We are starting to make enhancements where appropriate. Okay, this wouldn't be a year in review. Everybody is always poking and prodding me for my predictions. And, I always tell you, you can't predict the future. And this year's no different, but I thought I'd have a little bit of fun with it. So when you look at the odds of successfully predicting a coin flip, you've got about a 50% chance that you're going to call heads or tails correctly. Okay. And when you study the success rate of the forecasts from all the major Wall Street institutions, they're worse than a coin flip, 43%. So I'm going to go on a limb here and I'm going to predict that most Wall Street experts are going to get most of their calls wrong this year, which is why it's important to maintain diversification, control what you can, remain invested, don't panic. And I love this. This shows you that if you can stick to that, which again, it's simple, but not easy. If you can stick to that, we have never had a 15-year time period where you didn't make money. And as Matt so adequately, so appropriately pointed out earlier, many of you are going to have 2, if not 3, 15-year time periods left in your life. And so if we can maintain that recipe for success of staying disciplined, staying diversified, rebalancing through markets, not trying to jump in and out of them, we're all going to experience long-term success moving into the future. And so again, such a great reminder that there's so few things that you can control, that as planners, we take a lot of pride in the planning work that we help you to do, and really trying to control the things that you can control. And so there is one thing that I've asked Tina to speak on that is a planning point that is within our control. It's about Proposition 19, which passed in November, that may affect a few people here in the audience. And I've asked Tina to take a moment and talk about it.
Absolutely. Thank you, Brad. That was so much information to digest. So I appreciate all of the detail that you went into, and I know everybody on the call does too. So before we dive into question and answers at the end of our presentation here, our prepared remarks, I wanted to just touch briefly on Prop 19 because there is a deadline coming up. If you are going to act on preserving your property tax base under Prop 19, then you have a deadline of February 15th. And the reality is it's more like February 11th or 12th because the 15th is a holiday. And then we've got a weekend in there too. So I did put out a newsletter and a blog post regarding Prop 19 and what it means for anybody who owns California real property, and if you plan on letting your kids inherit that property. So I just put 6 bullet points here, and if you answer yes to these 6 bullet points, then it may be worthwhile for you to plan around Prop 19. So the first is obviously you own California real estate. And then the second, and I've highlighted it or bolded it because it's really one of the most important pieces, is that the fair market value of your property is significantly higher today than it was when you bought it. So you bought a home in 1960 for $200,000, and that home is now worth $2 million. So that's like significant. You have children whom you want to inherit this property. And this is also an important piece. Your children wish to retain the property. So they either want to, for a long time after your death. So they either want to use it as a rental property or a primary residence. And then the last 2 points is that you can afford to make the gift to your children. You don't need the equity in your home to live on for any part of your life. And then lastly, if you have Prop 58 exclusion left. So again, there's a deadline for this. It's coming up really soon. It won't, it's probably not going to affect a ton of people because the fair market value needs to be much different than the cost. And the people who are going to inherit the property need to hold on to it for a long period of time. So anyway, please reach out to me directly if you want to talk about Prop 19. Visit our website that has the newsletter and blog about the details around Prop 19. So with that, we are going to go right into question and answers. And we actually pre-populated 2 questions prior to the webinar today because they've been asked of us recently by several people. So we're just going to dive right into those. And the first question is, I've seen that Bitcoin has been really hot lately. Should we invest in Bitcoin or any type of other cryptocurrencies?
That is a good question. And as you mentioned, it has been asked a lot lately. And our answer is no. And the reason why is Bitcoin doesn't make anything. It doesn't produce anything. It's not creating a profit. It's more speculative in nature. And the craze around Bitcoin, it kind of reminds me a little bit of the tulip bulb craze in the 1700s, where people were bidding up the price of tulip bulbs. And the last people to buy in were the ones that really got hurt the most. And who knows where Bitcoin's going to go, but we would much rather invest in companies that make goods and services that people pay for, and that are much easier to value and to evaluate. And we can look at data and stats like EBITDA and net profit, et cetera. I think Bitcoin could potentially have a place as a hedge, kind of like commodities. But as Matt likes to point out, commodities haven't done anything in the last 15 years. So they can be a hedge from time to time. Our stance is we're avoiding Bitcoin at this point in time.
Okay, and that's a good segue into the next question regarding hedging and buying things of value. So the next question is, with the news of GameStop, AMC, do we invest in hedge funds or even engage in short selling? And I'll go ahead and answer that question. The answer to the question is no, we don't engage in short selling at all in our portfolios, and we don't invest in hedge funds. And so what happened with GameStop and other stocks last week was what's called a short squeeze. And it's basically where the retail investor pushed the price of certain stocks up, which caused these hedge funds to have to cover their shorts in stocks that they had shorted with the anticipation that those stock prices would go down. So again, we do not engage in short selling. We don't invest in hedge funds. We also, with regard to trading, we trade our portfolios on institutional trading platforms at TD Ameritrade and Schwab. So while platforms like Robinhood work for some retail investors, we don't buy or sell on those platforms. And we think that what happened with their trading was just basically their systems weren't ready to handle the amount of trading volume that went through. So again, as Brad just mentioned before about Bitcoin, like we prefer to own stocks of valuable companies outright. And while some hedging strategies may be reasonable to consider, especially in the case of if you have like a concentrated stock position and you might want to sell calls or buy puts against that particular security, it would be a strategic and an opportunistic play. So it's done really on an individual basis. But short selling is out of the question for us. It just brings too much risk to portfolios, in our opinion. Okay, and so the next question is, where do we see tax changes with the new administration in Washington?
That's a great question. So we were mentioning in October, depending on the results of the election, there could be potentially some changes. The one that we think is going to happen for sure is that we think corporate tax rates will be going up. The last several years, they've been at 21%. This is down from 35% before. And President Biden has said he wants to raise corporate tax rates back up to 28%. The good news is that they're not going as high as they once were. And the corporations today, companies that we're investing in, that you're investing in, are doing really well. Companies are very profitable. And so we anticipate that they're going to be able to weather an increase from 21 to 28%. We think that they're going to be okay in that environment. And excuse me, the other interesting thing is that when you look at the election results, it wasn't a blue tsunami. It was more of a light blue wave or a blue ripple, if you will. In other words, some of the more aggressive tax proposal and tax changes that were proposed, we don't think that some of the more aggressive ones are going to get passed. But we think that income is probably going to go higher on some of the highest earners, and corporate tax rates will be going up. And this is something that we're watching very, very keenly, and we're prepared with, depending on which way, if the laws are changed, we're preparing strategies to help people to keep the tax bill as low as possible, both before and in retirement.
Yeah, and I guess I would just add on to that the tax policies that are on the table, we think the ones that will get passed first will be the ones that are less controversial. So corporate tax rates and those on people making more than $400,000. So we think those that'll happen. And then once the new administration gets their feet under them, we'll start to see other things kind of hit the table. So those are the ones we're keeping our eye on closely.
Here's a good one that came in. Someone asked, how many times per year do we evaluate if people's portfolio should be changed? And will that change? Will there be any adjustments now that we've brought on some consultants to help us with? I thought that's a great question. The answer to that question is portfolios are adjusted on an as needed basis. And so what that means is years ago, we took a deep dive and we wanted to know, does it make sense to rebalance quarterly, annually, every other year? What's the right frequency and cadence around rebalancing? And we read every study that was out there, and we found that if you rebalance too frequently, you're actually you're kind of hurting yourself, because things may have momentum and they may be running, and you want to give them time to run. Things tend to overshoot and undershoot. So rebalancing quarterly was too frequently. And if you didn't really have any kind of system in place or didn't have a process, annually would be better than quarterly. But we like to go one step further, and we track the relationship of all of the asset classes in your portfolio. And there's 9 different asset classes, and we watch that relationship really every day. And what's beautiful with technology is we get notifications pushed to us in real time at a moment's notice if someone's portfolio has too much in the way of stocks and too little in the way of bonds, or vice versa, or has too much in the way of large growth and too little in the way of emerging markets. We get those notifications. So the way that we approach rebalancing is we can do it as needed in real time. And it goes back to the market bottomed on March 23rd. And I look back in really amazement, because we were doing heavy rebalancing right around March 24th, 25th, right at the bottom. And I would love to tell you that we're so, oh yeah, this is the market bottom, it's time to rebalance, but it's not how it works. It was our system that was telling us it's time. And it gives me a lot of comfort, and it should give you a lot of comfort to know that this system, it's time tested and it's foolproof, that when there are variations, and so the number that we've researched in terms of the stock to bond ratio is 5%. So when your bonds, and they were back in March, bonds represented 5% more than they should have been. So instead of being 40% in bonds, you were at 45, because they had gone up and stocks had gone down. Instead of being 60% in stocks, you were at 55. So that was that 5% discrepancy I'm talking about. And that was the trigger. And the bells were going off literally on March 24th. And this is not a coincidence. And I wish we could say it was because we predicted it, but it's a good system. And we've got the right software and technology. And so there won't be any change to that. Our consultants are simply were brought on to help us evaluate the portfolio, the efficiency of it, and their research really was in alignment with ours. They confirmed that the approach that we're taking is really best practices in the industry from all the other firms they work with, and that was a good confirmation for us.
Hey, Brad, I've got one for you that I think you'd have a good answer to. Are you a Dave Ramsey smart investor? And if not, what are your thoughts around his advice on investments, the fund investments equally between the 4 funds below, like growth and income, aggressive growth, and international? So doing 25% into each of those.
Yeah, I was a Dave Ramsey smart investor for years and years and years. And it got to the point where he charges a lot of money to be a smart investor. And while we still adhere to all of the Dave Ramsey principles, we no longer pay to be an official Dave Ramsey smart investor. Although we still believe very firmly in his tenets and what he does, and see as he's changed many lives. We're big fans. And so if you're out there doing this on your own, growth and income, aggressive growth, international, that's what he recommends. I'll tell you a couple things. That's a very aggressive posture. That is really, really aggressive. And if you did it, so you just have to be careful, and you have to be willing to accept above average volatility if you're going to go down that road. But if you're doing this on your own, there are worse ways that you can invest. We would say that a retiree that's at or near retirement probably needs to have a healthy dose of fixed income or bonds to the portfolio. And we like to really solve for how much should be in fixed income. And we like to take a look at 3 to 5 years of living expenses in fixed income or bonds. And that's simply to help you weather the storm or withstand the volatility. If we go through a 2008 financial crisis or a 2000 to 2002 tech wreck, dot-com bubble bursting, we want to have enough money that you can continue to maintain your lifestyle throughout, no matter what the markets throw at you. And so that's why we would introduce a small allocation to bonds. But yeah, we're big fans of Dave Ramsey, no doubt.
Okay, guys, we had a couple questions here regarding REITs, and do we think REITs are going to recover in the next couple of years, and will people ever really go back into the office full time with property owners, with rents not being paid and mortgages, paid during this pandemic? What do we see happening with REITs? And you guys can chime in. I think that we've been in contact with REIT managers over this whole year. We do think that we've talked about this internally. We do think people will go back into the office, that the collaboration thing with teams will, it sounds great now, but you can kind of see if you have been working from home, how that could maybe change in the coming years. REITs have had a tough time. They've had a really tough time. But we think that REITs have a position in every portfolio. And now may be a good time to invest in REITs. That's, I don't know if you guys have any other additional comments.
Yeah, the industrial sector has actually fared very well throughout the pandemic. So the industrial portion of REITs is doing quite well, and in particular, the couple of REITs that we have exposure to, they have right now over 40% of the real estate in the portfolio is. So, as data has now moved to the cloud, you got to have real estate that holds the servers and holds the equipment to be able to move to really a cloud-based economy. And so 40% of one of the REITs is exposed to sort of cloud-based real estate that has to do with the cloud. So there's a whole lot less commercial office space than you might imagine. And the commercial space has definitely been hit very hard. There's probably going to be a ripple effect of that, but I'm with you, Tina. I think that it's not going away. I think the collaboration that teams experience is important, but it's going to look different, no doubt about it. But in general, I think real estate is still a viable asset class.
And then one last comment. Do you expect the Federal Reserve to make any changes that will affect the markets this year? And again, you guys can piggyback on this, but I think that we've talked about this internally as well, that the market and the economy is still fragile. So we expect that interest rates will remain low while we get through this and heal our economy. So with that being said, I don't anticipate anything that will affect markets. We're going to see volatility, no doubt, in the coming months. February is typically a volatile month after an election anyway. So, we're going to see volatility for sure. We expect it, but we don't see anything where a situation would cause us to change our philosophy or anything investment.
Yeah, and go ahead, Matt.
Oh, I was just going to say, to piggyback off of what Tina just said, we never want to make changes to the investment portfolio for individuals based upon what we're hearing from the street or anything like that. We always want to make the changes based upon the plan and let the plan dictate why we're making changes. That's just another way of market timing, like Brad went over. You guys are going to hate us hearing that over and over, but it's just so true that market timing doesn't work, and we just want to make sure that we're making changes to the portfolio because of the plan and not because of what we think may or may not happen.
Yeah, such good points. And Tina, I've heard you make a really good point that's probably worth mentioning here as well. And you said kind of what made the 2020 market decline different than others is it was driven by the pandemic, which in many ways is more like a natural disaster with kind of a start and a finish. And so it was very deep, but perhaps the reason why it was so fast in terms of the downside and even the recovery is because with the vaccine in sight, it's the rollout has not been perfect, but it's in sight. The light at the end of the tunnel is there, and that's what makes this one very different than the Great Recession of 08, 09, and the recession of 2000 to 02. So I thought your point on that, Tina, was really interesting and on point.
Thanks. So that's all the questions that we have today. Brad, do you want to make some closing remarks?
Absolutely. As always, we just want to thank you for your trust and confidence that you place in us and our team. We, as you can see, we are passionate about what we do. We live, eat, breathe, and sleep this stuff. And we like to say around here that we are going to care more about you than anyone that doesn't share your last name. So we love working with you. We really want you to feel like you're part of the family. And I'm so excited to have just some real rock stars like Tina and Matt on the team, and Jerry and Stephanie and Stacy and Al, just a great group of people here to serve all of you. And we don't take that trust and confidence lightly. We take that very seriously. We love working with you, and we wish you continued success and health in the coming year. We look forward to talking with you soon.